Last time we talked about your financial foundation, which is intended to smooth out the rough patches in your life so you can focus your financial efforts where they need to be and not be distracted by all the problems that happen in life. So your financial foundation contains your skill building account, so you can always be productive and command more receipts for your value added society, more money. It includes your emergency fund so that when something happens, it's an inconvenience, not a catastrophe. Emergency preparation so that when money won't do you any good, you'll be able to have the necessities on hand to smooth out those rough patches. And then finally, your wealth foundation. We just kind of glossed over that a bit. We're gonna talk about that more tonight. But so 10% of everything you make should go into your financial foundation, with the goal being that you meet the goal for each of those levels. And eventually, most of that 10% goes towards your wealth foundation. Now, your wealth foundation can be just a savings account. I recommend a high yield savings account if that's what you're going to do. But it can just be a savings account if you're extremely averse to investing. I'd highly recommend you at least get to understand what investing is and history behind it, so that you feel more likely to do some investing. But if you are completely averse to investing, you can do okay just putting your wealth foundation into a high yield savings account and letting it grow until you're ready to pull from it. That said, some basics to hopefully help people feel more comfortable investing is that all investing is putting your money and purchasing a portion of a corporation, or purchasing the debt of a corporation in the case of a bond or the United States government. And so all it is buying a piece of it. And he'll say, well, it can go down. You can lose your money. Yes, you can. You can lose your money by not investing. If you just keep it in savings, you will be losing money. You'll be guaranteeing losing money, because even in a high yield savings account, you will not get back more return than inflation is hitting your money. So it doesn't matter where you put your money. You could lose money, and you put it in a savings account, you will lose money. You can do okay, but you will lose money. There are things in investing that once you understand the basics, you can minimize the amount that you lose. And really, when you're investing, for instance, in stocks, corporations, you don't lose money until you sell. So if you structure things right, then you'll never lose money because you're not going to have to sell. So structuring your financial life in such a way that, yeah, you invest, money goes away. And one thing to remember, any money you invest should always be money that you are okay losing 100% of, and you'll still be okay. So we're talking about your financial foundation, your wealth foundation. Eventually 10% of almost 10% of your income starts going into these. It could be your company 401k, for instance. And that's often a fantastic place to start, because one, it gets pulled out of your paycheck automatically. Two, companies often will give you a match. So for instance, they may say, put 8% in and we'll match half of that. So let's say that you make 100,000 and you put in 8,000 that year, the company would match at 4,000. So you really have 12,000. You put in 8,000, they'll put in another 4, you'll have a total of 12,000 invested that year. And so that's a really great way, because the company gives you free money. It's another way to get more money from your job. So let's start with just that basic of a 401k. What is a 401k? It's just a way to have a tax advantaged retirement fund. The idea is you put money in there and you wait until, well, now it's at least 55. Some laws just changed, but you can pull money out somewhere between 55 and 59 and a half and start pulling that money back out when you're retired. And the idea is that over your career, putting money in there, it should grow to the point where the growth is much more than what you put in. And historically, if you invest correctly, historically, that has proven to be a very, very good way to go. I'm also going to say that just because it happened in the past doesn't mean it's going to happen in the future. And the more history it has behind it, the more I trust it. That's why I didn't start buying any cryptocurrencies for investments until after we had at least a decade of history. And we still don't know what's going to happen there in the future. But for investing, you don't have to worry about cryptocurrencies and that kind of thing. The US stock market has a huge history, well over 100 years of history behind it. And so basics are, if you invest in what they call index funds. So for instance, there are index funds that track the total US stock market. And that means that you're investing in a little bit of every single company in the United States. So the only way for you to lose everything is for every company in the United States to go under at the same time. So that's one way to what they call diversify, is you spread your risk out over multiple companies, and the chance of any one of them failing doesn't bother you because you're spread out enough that one failing doesn't impact you. One going down doesn't really impact you. So that's the basics of it, is that if you do something where so often in 401ks, they have a limited selection of things you can invest in. Often they'll have a stock index fund. It may be an S&P 500, which is just 500 of the top companies instead of all of them, which is fantastic. It historically has had better growth than all US companies, partly because they only keep the top 500 companies in the world in that fund. And so if one is no longer one of the top 500, it drops out and a new one takes its place. So that tends to be a pretty good fund too. So often there'll be an S&P 500, maybe an all stock market fund. You'll see some bond market funds. And then you'll see what's called a target date fund. That's now really popular in 401ks. And the idea is that you say, well, I want to retire at this date. And so you set that as your target date. And then when the mix of things in that are professionally handled by someone. And so they'll go and say, well, you're young, so we'll be really aggressive. And then as you get older, you'll start going, well, you're getting older. We'll probably want to go more towards bonds and maybe more cash, things that are safer, so that as you approach retirement, it's not fluctuating quite as much. Those, a lot of people like them because it does the magic for you, but it comes at a cost. And in investing, costs are what kill you. A very small percentage cost over time can completely decimate large portions of the wealth you could have had. So I recommend an index fund that's not heavily managed. The way you can look at this is you look at what's called the expense ratio. So you look at the fund, you look at the performance. Okay, yeah, these are good, that's bad. But then you go down and you drop down, there's a number that's called the expense ratio. And that's how much they take out of that fund to pay the people who are managing it. And so something like a 0.04%, that's going to be fantastic. 0.06, even 0.1% is great. 0.12 maybe. 0.12, but you start getting into actively managed, which if you look at the target date funds, they have much higher expense ratios because people are actively going in there and evaluating what they need to put in to get it to the right spot. And so it's a higher fee. I'm not a big fan of that. I was a fan of the concept until I saw the fees involved with it. So if you're taking, let's go back to the beginning. So we're taking 10% of our income and putting it towards our financial foundation. We build up our emergency fund. We build up our skills account so we can invest in our skills. We have our emergency fund. Those are all filled out. So now, let's say 9% of our income is going into our wealth foundation. Let's say we say, okay, we're going to have that just pulled out of our paycheck, 9% of our income, have it automatically go into our 401k. Let's say maybe we get a 2 to 4% match on that. So now we have, let's say 4% match. So now we've got 13% of our income, 9% of which we put in, but the 13% going in. And then over your career, that becomes, let's see. In 2 years, you have almost 30%. So in 4 years, you would have, let's say 30. So in 7, 8 years, you would have accumulated, put in there a full year's worth of income. But that means every 4 years, you're going to add another year of expenses you can pay for in your account. The other side of those, that doesn't count the growth. And so if you invest in, let's say, an S&P 500 index fund, then the growth historically has been pretty high. I'm going to be conservative and say, let's say it's 10%. That means in addition to that, you get another 10% on top of that. The following year, you get 10% on top of that 10%. And that compounding, while it starts out slowly early on, it starts growing. And it gets to the point where what they say in the industry is that if you can live off of 4% a year off of your income, let's say you had $1 million that it grew to in that account over your career, and then you could pull out 4%, and that would be $40,000 that year, and you could live off of that. So if you can live off 44% of whatever your investment is, then you're fantastic. You can do that. People argue about how long you can do that for, but at least 30 years is the consensus. Some say forever. Because the idea is that historically it will grow more than 4%, and that the more than 4% will cover the inflation. So it'll continue to grow. Anyway, so that's the basics of the Wealth Foundation. Is you want to make sure that you are have your financial foundation in place before you heavily go into a wealth foundation. So make sure you have your emergency fund, your skills fund, and your emergency preparation fund filled out to whatever your goal is. Like we talked about last time. You want to go back, look at the previous one I did. And then you start out with at least 1% of everything you ever make goes into your wealth foundation. If you can educate yourself about investing and feel comfortable doing that, I highly recommend doing it. Start with just the basics. A stock index fund and maybe a bond index fund. You want the bond index fund to be a low percent, like 25%, maybe 75% in stock index fund. And that gets you a standard basic investment portfolio. So highly recommend, one, every time you make money, set 10% aside for your wealth foundation, your skills account, your emergency fund, your emergency preparation. And then once you fill those up, it all starts going to your wealth foundation. But then two, you start building what I like to call your long-term emergency fund, your protection, your emergency fund against the time when you can't actively make money. So emergency fund, it's like, hey, I want to cover 3 to 6 to maybe 12 months of expenses. That's great because you need enough time if you lose your primary income to find time to go back and rebuild that income back up, find a new job, transition your business, whatever. But there will become a time where for some reason you will not be able to physically make more money. So the idea is that's what this is for, is to build a fortress that you can retreat to in a time when you can no longer actively make money. If you do it well enough, you could get to the point where that time, the fortress becomes so big and so strong that you don't have to worry about when you do it. You can do it when you're ready. You get to the point where it doesn't matter what happens at work because I can retire at any point. Retirement is not an age, it's a number. And that number is when it gets to where you can live on 4% of whatever your portfolio is. You could live on that much a year. So your wealth foundation, some people think of it as retirement accounts, and there are, like your Roth IRA, your traditional IRAs, your 401ks, your Roth 401ks. Yeah, those are great. But think of it not as retirement, but more as a protection against a time when you can't It's a super emergency fund. So when the time comes when you can't make any more money physically, you can't actively participate, make more money, it will be there for you to soften that blow and let you ride the rest of your life out. You can build it strong so that you can do sooner than that. But that's the general idea of it.